think it is, thank you very much. I think it is a very important figure. PCE is more important because it's the favorite gauge of the Federal Reserve in terms of measuring inflation. However, I think that it's very important for a very simple reason, is that rate cut estimates from the street are way too optimistic, and therefore any indication that rate cuts will not come in March, and that the market is starting to realize that that is not going to happen, and that may not come either in the next meeting, will certainly move markets significantly, and particularly the long-dated assets, which are the ones that require a very significant change in the monetary policy of the Federal Reserve. So I am expecting basically a print that will basically make it very clear that investors should start to realize that, on the one hand, rate cuts will not start as soon as many expected, and more importantly, it's a year of elections. It's very difficult to see the Reserve cutting rates at each meeting in the middle of a very contentious election.
Daniel, then do you think rate cuts are bound to come sooner rather than later then, if the Fed will choose liquidity over financial stability, or rather liquidity and financial stability over inflation control, as you note?
One of the things that I think is very clear is that the Federal Reserve is paying a lot of attention to the problems in the commercial real estate market, as well as problems in the regional banks. So liquidity is going to be something we're going to be there no matter what. I think that it was very clear in 2023 that the Federal Reserve is not going to reduce liquidity. But I think that rate cuts should be adjusted to the reality of inflation, and therefore what we are likely to see is a gradual process of rate cuts as inflation cements its position closer to the target of 2%, while providing ample liquidity to avoid a financial crisis. So in every measure, what we think is that the Federal Reserve is going to do exactly what it did in 2023, which is to put liquidity and financial stability on as the main priority of any other measure, including being more drastic on inflation. So very gradual on inflation, but certainly accommodative to the extreme in any event that may rock markets or bring confidence down.
Hey, Daniel, very nice to see you. Just with inflation where it is, and with core where it is at the moment, and the labour market where it is, and the household balance sheet seemingly okay at the moment, despite some concerns about revolving credit, how can the Fed cut in the timeline that the market still hopes for?
I think that the Fed is not going to cut in the timeline that markets are hoping for. If you look at the expectations of consensus, what you see basically is that they're moving one meeting ahead, their estimates of rate cuts, and that consensus estimates for rate cuts in March have come down massively very recently. I'm also even surprised that anybody thinks that there's going to be a rate cut in March. So I think that the next phase is for markets to adjust those rate cuts, which are likely to happen anyhow, because it's basically the Fed simply just moving to neutral rate. And if you think about that, both things are acceptable. You can see a gradual decline in inflation, but still persistent inflation, which is the point that you have made very clearly. And I think that that is the main concern of the Fed. So persistent inflation, gradual return to neutral, and keeping rates as close to neutral as possible. That means a few rate cuts, but not as many as consensus expected at the beginning of the year and still expects today.
Daniel, you and I have spoken for well over a decade probably about concerns about debt as well. In fact, one of the biggest debts out there is on the sovereign balance sheet. But no one seems to mind about this at all, whether you're in the States, whether you're in Europe, whether you're in emerging as well. It's always tomorrow problem. It's another president's problem. It's another prime minister's problem down the line as well. Is that the right attitude for the moment? Worry about the crises here and now and worry about debt on another occasion?
Debt is the biggest problem of the whole economy. Public debt is not free, and public debt is not irrelevant. It creates lower growth, lower productivity growth. It also crowds out investment and certainly means more taxes, more inflation, and certainly more cuts in budget in the future. So public debt is a real problem. It's a real drag on the economy. 2024 is a very challenging year for a very simple reason. We have more than 60 elections globally. It's a year in which more population is going to vote than what we have seen in recent history. And that means that governments are not going to pay attention to fiscal responsibility, and they're going to spend as if nothing was happening. So in a year in which monetary policy is going to continue to be slightly contractive or accommodative, but fiscal policy remains hugely aggressive. The problem is that the crowding out of the small and medium enterprises, of families, is much larger. The entire burden of the rate hikes and the reduction of liquidity that may come in the economy, or certainly the reduction in availability of credit, is falling on the shoulders of small and medium enterprises and families. And that's why the discontent, despite headline positive figures, is rising. So we have to be very aware of the negative effects of, and certainly the attitude of some governments of thinking that, well, this is not our problem, let's pass it on to the next administration, certainly doesn't help, because the decisions then to reduce imbalances are going to take longer, and they're going to be more negative on the overall economy.
Daniel, thank you so much for the time. I'm going to have to leave it there. Daniel Lacalle is the chief economist there at Tracy's Gestion.